Ladies and gentlemen, welcome to another episode of SAF for Learning It Quick. My name is Dinesh Balakrishnan, and this is another AFM101 video for you. Now, if you didn't get a chance to look at the first introductory video, please do so now. The link is provided in the top left corner. That video covered essentially the foundation or the very purpose of financial accounting, so you might be a little lost without looking at it first. If you do want to look at it, take a look at it now. But in this video, we're going to be covering the different types of financial statements that come up in your course. So we're first going to look at why do we need financial statements, and then we'll jump right into some examples or different types of financial statements. So first of all, what is the purpose of financial statements? So similar to the purpose of financial accounting as we covered in the first video, it is to enable decision making first of all. So let's go ahead and write that down. So to enable decision making. And we covered the topic of stakeholders in the last video. So you had people like, you had managers, which are a type of internal stakeholder. And you also had creditors, suppliers, customers, and those are different types of external stakeholders. So financial accounting is essentially serving those external stakeholders. It is a way to provide financial information. You know, it's a way to provide these numbers essentially in a nice, neat format to these stakeholders to allow them to make their decisions. Now, as I did mention, it is in a specific format, so it is standardized, and this is to essentially allow for comparability between year over year. So if I have financial statements dated back all the way, say, from 2005, then to allow me to assess those numbers year over year, I have to have it in a way that's consistent year over year. So if I have it in one format in one year and a different format in another year, then how do I compare it between those 2 years? So we have to maintain a specific format that is prescribed by accounting standards. I know that got a little jumpy, but we have specific accounting reporting standards that we look at. Now these are just the main two that we're looking at. So if you haven't paid attention to the financial accounting news recently, things have changed quite a bit in the financial accounting world. We have traditionally relied on something called private enterprise GAAP. Now GAAP, if you haven't never heard of it before, stands for generally accepted accounting, go figure, accounting principles. Now this is essentially a sort of rule book, if you will, of how to play this game. Now GAAP, GAAP, is what we traditionally relied on for reporting purposes. They are still in existence, but what has happened is to remain consistent internationally, because of globalization, a lot of companies are now working internationally as well. So to maintain sort of consistency across the world, financial standards have been created to allow for consistency around the world, essentially. So and those are called IFRS, or International Financial Reporting. Reporting standards. So without going into too much detail, what has generally happened is all the public companies are now required to use IFRS. So they have to report in a specific format, which isn't that different at all from PE GAAP. There are certain distinctions that can be made, but overall, public companies must report using IFRS. And private enterprise GAAP generally applies to private entities, so companies that are privately held or not traded publicly. Now, these private companies can elect to either use IFRS or remain with their current standards in PE GAAP. And there's obviously certain differences when it comes to that, but we won't go into too much detail into that right just now in this introductory video. the reason I want to emphasize consistency is because let's just take a look at, this is a very dumbed down example, but something that you might be familiar with. Let's just say you had trading cards. Now, I have 2 trading cards here. I have 2 monsters, and they have, it's pretty consistent. They have hit points right here, HP. They have attack, they have defense. Without having this consistent format, if it was, HP was all of a sudden not mentioned, or if it was mentioned in a different format, not have a bar but have dots or something, HP had dots, and then if I had attack, rather than having a number, I had number of stars or something like that, how could I possibly compare one type of monster to another? If I had these 2 monsters facing off one against the other, then how would I know which monster wins? Or how would I know if I have enough defense to cover the attack? You can't, because unless you have some way of converting each dot into a numeric value, then how do you possibly compare these 2? For example, so to allow for comparability, you have a consistent format that is used year over year, financial statement over financial statement, and that remains consistent. So that allows you to check out figures from as far back as, let's say, 2005 again, and you can see trends in how net income has increased year over year, or if they're in a really tight cash position, you can kind of assess when they might come out of it, or it just gives you a basis for conducting a bit more analysis if you have a consistent reporting year over year. Now, we are now going to take a look at the different types of financial statements. So as I did mention, they're the old type and the new type. So we looked at PE GAAP and IFRS. Another name for PE GAAP is Accounting Standards for Private Entities. So ASP and PE GAAP are synonymous. If you do come across those in your textbook, just know that they mean the same. If you had the opportunity to take accounting in grade 11 and 12, you might have heard of these types of financial statements. So you've had the balance sheet, the income statement, statement of retained earnings, and the cash flow statement. If you've never heard of these, don't worry, we'll take a look at those in greater detail in next couple of videos, but I just wanted to introduce the various types of financial statements now, just so that you're familiar with the terminology and the names. Because there's a shift in the accounting standards, you're likely looking at a textbook that makes a lot of reference to IFRS, and the names have sort of translated over quite decently, I'd say. A balance sheet is now called the Statement of Financial Position. Then there's the Statement of Comprehensive Income, Statement of Changes in Equity, and the Statement of Cash Flows. So these are sort of the translation, or the IFRS version of the old financial statements. Again, as I said, we will take a look at an in-depth look at each one of these types of statements in the next few videos, but I want you to take a look at these equations. I know they look a little daunting at first, but what is essentially happening here is I want to try and at least break down the balance sheet for the time being. Let's start off with that. So a balance sheet is a statement of financial position. It is essentially a snapshot. It's a snapshot of what is happening at this very moment. Snapshot of now, of what is happening now. And how do you look at that? So you have in your books, you have assets. You have assets on one side, right? You have assets on one side, but how do you fund this asset? So suppose you bought a machine to produce widgets. How do you fund that machine? Either you can do it either one of two ways. Either you had money from before that you invested on your own to purchase that asset, so that being under equity, or you borrowed the amount from a bank or another institution or creditor, and you funded it through debt. So this is debt, and this is equity, right? Now, the balance sheet, what it's telling you is, now this is my interpretation of it, is essentially list all your assets, then determine how you funded those assets, either through liability or through equity. Within equity, obviously, there's a breakdown because there's retained earnings, net income, dividends, things like that as well. But the shareholder equity portion of it, right, your share capital is essentially what's funding your assets if you funded it yourself. And within liabilities, if you have things like, accounts payable, long-term debt, bonds issued, things like that, things where you owe money, anything that you owe is a liability. Now, as I said, if you bought the machine through borrowed money, it generally means that you funded it through debt, which is why it would sit in liability. Now, if you've heard of double entry bookkeeping, you likely probably did so in your grade 11 and 12 courses. There are debits and credits. And we know, I like to think of it in a similar way to Newton's third formula of motion. Every action has an equal and opposite reaction, right? Equal and opposite reaction. So, using those principles of physics, no, it has nothing to do with physics here, but I'm just trying to use a reference that might appeal to you. Every debit that you have in your books has to have an equal credit associated with it. So in this case, if we were to have a journal entry, right? So in your journal, list of all your journal entries, you would put in, if you were to acquire this machine, you would have debit machine, right? For the machine account, for the machine account, you'd have, let's just say this costs $10,000. So you'd have machine 10,000, and credits, you'd have a liability. So let's just say you took a long-term debt. So you went to the bank, you said, I need to buy a machine for my business. Can you give me some money? So they lent you some money. So you said long-term debt, $10,000. Right? So for every dollar that's in your assets, sitting here, there's a dollar of equivalent and opposite value sitting in either liability or equity. So in this case, it's sitting in liability. Coolio? Okay, so that's essentially the gist of your balance sheet, right? It's a snapshot of now, right? It's giving you your financial position as of this very moment. All your assets on one side, your liabilities and equities on the other side. Your statement of comprehensive income, I'd like to call it just income statement for the time being, because statement of comprehensive income is a couple of terminology that I don't really want to get into right now. It might confuse you, but the income statement is just looking at what money came in, what went out, and what's left, or what I made, right? Your revenue, your sources, things like sales. If you were producing items, you sold those things, generated revenue, so money came in, and you all had expenses that you incurred, obviously. So expenses like operations, administrative expenses, salaries that you paid your employees, generally list of expenses. It's quite extensive, but anything that came in minus what went out is what you made today. And what you made today could potentially be a loss as well. So let's just say net income or loss, because that is definitely possible. And it's very common for small businesses or just recent startups to incur big losses in the first 2 or 3 years and generally pick up after that. So we can't necessarily rule that out. Your statement of retained earnings is looking at, well, you know what, let's take a look at what retained earnings is first. Retained earnings is the cumulative amount of of net incomes or losses, because we did mention that, net income or losses for all years of operations, for all years till now. Right? So it's kind of like it's kind of just an account which accumulates year over year whatever the net income was. So if I had first year of operations retained earnings is likely going to be zero. Your beginning retained earnings. Then look at this. You add on to that the net income for the year, right? You add on to that the net income for the year, minus any dividends that you issue during that year. Okay, and the net result of it. So the net of this is added on to the beginning retained earnings, which gives you the balance at the end of the year. So if you had to start off with in year one you had 0, you added on to it net income of, let's say, 10 net income. Take away, let's say you declared a dividend of 5, then you're left with, well, 10 minus 5, which is 5. So your retained earnings ending for that year would be 5. And it's tracked year over year. So then in year 2, this would become your beginning retained earnings, and you go through the entire process once more. And finally, your statement of cash flows, your cash flow statement, it's the pluses and minuses of all the cash flow that occur for 3 separate activities. Any activity that a business engages in can be broken down into one of these 3. It's either an operating activity, an investing, or a financing activity. We'll look at exactly what each one of these are in a later video, but in essence, operating cash flows are anything from general operations. So by selling items that you sell, any cash flows that you incur, you'd back out things like depreciation on your assets, stuff like that. And your investing activities include things like purchase of the machinery. So the machinery that we purchased in the example above would be a negative cash flow that occurs here. So you'd be minus 10,000 for cash flows from investing activities for something like that. And cash flows from financing could be things like share issuance, where if you issued some share, money came in, so that'd be a positive financing activity, and you net the effects of all of these, and you get a net change in cash, which you would add or subtract to your current cash position. So you have your beginning of the year cash amount, which is sitting in your assets in your balance sheet. You would either plus or minus this amount, which would give you ending cash for that year. So these are just very quick, sort of brief overview of the financial statements that we looked at. Again, I will make more videos looking specifically at each financial statements. In fact, what we'll do is we'll look at examples of different companies. We'll take a moment to look through their financial statements to understand the breakdown. And yeah, so those are the next few videos coming up. We'll look at first the balance sheet, or the statement of financial position, the statement of comprehensive income, changes in equity, and the statement of cash flow. So stay tuned for those videos, but for the time being, take care and best of luck. Catch you soon.